This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Fitch strips the U.S. of its AAA credit rating, echoing a move by S&P more than a decade ago. The decision draws criticism from Larry Summers and Mohamed El-Erian. Treasury Secretary Janet Yellen calls it arbitrary and outdated. Former President Trump charged. The former U.S. president has been indicted in Washington on federal charges over his efforts to overturn the 2020 presidential election. But in the midst of all of that drama, earnings season rolls on. AMD rises on AI optimism while Starbucks slips on disappointing sales. Welcome to Bloomberg Surveillance, the early edition. I'm Dani Berger in London with Kriti Gupta in New York. Kriti, it is ugly out there. It looked to have started with perhaps the Fitch downgrade, but at the moment, equity markets seem to be spiraling into something else.
Yeah, they really are. But look, it's not a similar reaction across all asset classes. Dani, the last time we had this kind of downgrade from S&P, about 12 years ago in 2011, you saw this massive bid into the bond market, essentially being that even the irony that the U.S. government may not be as safe as before, it is still the most safe in the world relative to all the other countries. So naturally, in a crisis, if the world's going to end, you still buy U.S. treasuries. That is not the same dynamic that is playing out in today's trade. So even though we are seeing this massive sell-off this morning, futures down almost, well, pairing some of their losses, but down almost 1%. NASDAQ 100 futures really taking a hit there, down about 1.2%, again, off of their lows from that pre-market trading. The bond market is seeing a bid, but only on the front end of the curve. Go out to the 10-year and you aren't seeing that same bid. In fact, 402 out on the 10-year. And I think that's pretty significant, Dani, when we talk simply about this allocation of just how much panic is there. Is this, at the end of the day, an equities positioning story?
I think that's a really good point, because in terms of equity land, we're really short vol right now. We basically don't have any hedges. We've talked about this before, how cheap hedges are, which suggests no one's buying them. We're positioned on very front end vol short. We're not really long further out. So what happens if this gets worse? Could it snowball because of positioning? Here in Europe, we're seeing the sell-off, the worst sell-off in about a month. Europe stock 600 down more than 1.5%. FTSE 100 doing even worse, nearing the 2% decline target. In Europe, we've had a whole lot of earnings. That doesn't seem to matter today. Every single sector is into the red. If you look at what's leading us down, it's growth stocks. It's similar to what you're seeing in the U.S., Kriti. You pointed this out with what tech is doing. And growth is the best performing factor year to date. So maybe it is taking profit on some of the winners, some over positioning, that today we're using this volume as a chance to correct for that. One of the interesting things, I just want to point this out, because the yen is doing well today. That haven bid, it's not the same here in Europe. The Swissy is falling. The Swissy is weakening. The dollar outperforming by 0.2%. Now, it might be some eco data. Switzerland's PMI manufacturing came in at a 14-year low, so the Swiss economy not looking so strong. So, again, it's not necessarily a logical market today, Kriti.
Yeah, a lot to digest, certainly. And to your point, Dani, it really all started with that Fitch news, that credit downgrade. It has been swift, investors weighing the ripple effects. Take a listen to what some of our guests on Bloomberg had to say about the decision.
I disagree with Secretary Treasury Yellen's notion that this was arbitrary.
Look, the Fitch rating downgrade came as a surprise.
It's a few things that do surprise us a little bit in terms of their estimates.
So there is a governance problem, and that is truly a problem that we'll face going forward.
This comes at an economically sensitive time, but I think this is the last thing that Yellen really needs. But from a market perspective,
If the U.S. economy continues to show resilience, I think markets will just brush off.
Now, of course, we know that the U.S. has had its debt problems, but there was a lot in Fitch's reasoning. Joining us now is Bloomberg's Valerie Teitel. Walk us through everything Fitch kind of touched on when it comes to how they came to this conclusion.
Sure, Kriti. I urge everyone to take a look at the announcement by Fitch and read it, because it was really just in that first paragraph in their announcement. They labeled 3 key things that triggered this decision. One being the expected fiscal deterioration over the next 3 years. They cite tax cuts and those spending packages specifically. Secondly, a high and growing debt burden. They do spend a lot of time talking about the debt to GDP ratio as well as the swelling deficit. And lastly, the erosion of governments and confidence in fiscal management. As they noted, it has manifested repeated times in debt limit standoffs and last-minute decisions.
Why now, though, Valerie? Because this has been the criticism. The debt ceiling drama has passed. The economy is on solid footing. So why would they do this downgrade now?
No, you raised some great points, Dani, especially if we look at the 2011 example. S&P's downgrade came days after the debt limit was concluded back then. And you're right, the U.S. economy is growing very, very strongly. It's really hard to say why they chose now, but Yellen out calling it a arbitrary and outdated decision. She says that, yet we need to look at what the things the Treasury has announced just this week. On Monday, they announced that third quarter borrowing is hitting a record high. $1 trillion of Treasury issuance now expected for the third quarter. That was way above estimates. And it was only a few weeks ago that we saw those annualized interest rate payments nearing $1 trillion for the U.S. government. So, you know, you can say that Fitch does raise some good points, but it's not necessarily anything new and fresh. But perhaps we should be congratulating a ratings agency for being forward-looking instead of backward-looking in that manner.
Yeah, learning their lesson 12 years later, perhaps. Valerie, talk to us again about, you made that comparison to 2011. You're not seeing the same reaction in the bond market here. Walk us through kind of the market fallout when it comes to maybe what the logic is here in terms of trading this.
Yeah, and I want to bring up what Mohamed El-Arian said in response to this, because I think it's really telling what the markets are doing this morning. He said that the market is much more likely to be dismissed than have a larger impact on the U.S. economy and markets. And that is exactly what we're seeing this morning. Yes, we're having a risk-off tone in the equity markets, but a lot of that was baked in before this announcement even hit yesterday. There really isn't a big bid into any safe haven assets. I know Dani just pointed out Swissy there. The Swissy is actually weakening today. We're seeing a tiny uptick in gold, up 0.3%, but really not this big safe haven bid that maybe you would expect given what happened after 2011. And then even if we take an eye over to the Treasury market, 10-year yields basically unchanged on the day, Kriti. Now, maybe it's ill-advised to compare the market reaction today versus what happened in 2011, because in 2011, it really came days after the debt limit standoff was concluded, and it was the first time the U.S. had seen the downgrade. So perhaps, you know, the second time around, the market just shrugs it off even more and, you know, it essentially doesn't change any investors' long-term view on the market. And maybe at the end of the day, this decision will be you know, frankly, irrelevant.
And it's worth pointing out that the next debt limit standoff, by the way, January 1st, 2025, about 7 to 8 weeks after the 2024 presidential election in the U.S. side, which also coincides with the lame duck session in Congress. So we really are setting ourselves up for a lot of struggle ahead. Valerie Teitel walking us through all of the market moves. We thank you as always. And we go from the debt story to the political story. Former President Donald Trump has been indicted on federal charges over his efforts to overturn the 2020 presidential election. Special Counsel Jack Smith announced the charges yesterday.
In this case, my office will seek a speedy trial so that our evidence can be tested in court and judged by a jury of citizens. In the meantime, I must emphasize that the indictment is only an allegation and that the defendant must be presumed innocent until proven guilty beyond a reasonable doubt in a court of law.
Joining us now, Bloomberg's Mark Champion, senior reporter for international affairs. Mark, look, we've been following Donald Trump's kind of legal issues for a while now. Why is this time different?
Well, you know, there are two things to say there. So politically, it isn't clear that this time will be different. He's going to be, you know, have to appear in court very soon. And, you know, these are big charges. And they come on top of a series of other cases. And until now, at least, these cases, if anything, appear to have helped him politically. So he is way ahead in the polling for the Republican primaries. You know, we don't know that this will be any different. You know, what has happened is essentially that, the country is divided into two camps, one of which sees every new charge as evidence of Trump's, ill-doing and unfitness for the presidency, and the other sees every new charge as further evidence and proof of a conspiracy by some kind of deep state to exclude him from the presidency. So it's not clear that this will be different politically. In legal terms, this is a really interesting case in the sense that it's basically a case saying here it is a crime to undermine democracy in the U.S. and to do so through lies, deliberate lies. And that's what he is accused of, a conspiracy through lies to undermine and to upend the election results.
Now that we have this indictment in hand, what follows on the timeline as he also faces a series of other legal challenges?
Yeah, he has a number of other challenges. September the 1st, by September the 1st, there may be a new case. This is in Georgia, again, about, the election result in 2020. All of this is going to happen during the presidential election campaigns. And therefore, it will be deeply, deeply political. Also, it will have a financial impact. It's expensive. He's already spent more than at least $25 million on defending himself in these cases. That money will take away from his campaign. He raises it, through his campaign funding, and that money is being diverted. So, while President Joe Biden, is able to sort of build up a war chest ready for the election campaign, doesn't really have to deal with the primary. Trump has to both deal with the primaries and he has to pay for his legal fees for these cases. And that could have a real impact in emptying his coffers by the time it comes around to fighting a presidential election campaign.
So that's the Trump story. Let's get to the Biden story as well. The Financial Times reporting that Biden will be asking Congress to fund arms sales to Taiwan via the budget that they've set aside for aiding Ukraine. Mark, talk to us about the ramifications if that does indeed come true.
Yeah, I mean, so already it's quite, it's becoming politically controversial in some quarters. The amount of weapons, sometimes that's, conflated with money, but ultimately it will end up as money, as all the weapons need to be replaced. And that's being sent to Ukraine. So once you start then diverting that in order to get spend on Taiwan, it becomes even more complicated.
Okay, Mark, thank you very much for that. That's Bloomberg's Mark Champion. Coming up on the show, an exclusive interview with Stephan Caron, BlackRock's head of European private credit, as they close a major deal. And more on the Fitch fallout with SocGen's global chief economist Klaus Baader still ahead. And we'll continue to monitor the markets. Your S&P 500 futures session dips further, down 0.8%. European stocks down more than 1% as bonds and dollar are bid. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. BlackRock is looking to become a one-stop destination for private markets, a more lucrative area of finance than just bonds or equities. Now, as part of that push, the firm has now closed its acquisition of Kreos Capital overnight. Kreos, a London-based private debt manager, has committed more than $5.6 billion in deals since its inception in 1998. Joining us now is the man behind that deal, an exclusive interview with Stephan Caron, head of European private credit at BlackRock. Stephan, thanks so much for joining. Look, this deal is interesting because it's not plain vanilla private credit. You're looking at venture debt at this moment. Why venture debt and why now?
Yeah, look, we think that venture debt in Europe in particular is a very attractive area. It's still very much underdeveloped compared to the US, right? If you think about the venture debt market, it's about a 57 billion market. Europe is only 10 to 12 billion of that, but Europe is growing 40% every year. And this is probably an attractive entry point into the market, given everything that's happened into the broader banking system as well. So we're very excited to acquire the platform. They obviously, as you said, have a 25-year track record. That's tried and tested over the cycle as well.
It makes sense for a venture company going and seeking debt right now, Stephan. As you point out, SVB is no longer around. There was a UK arm of that too. The volatility there, valuations have fallen, so maybe you don't want to do a down round in terms of funding. But behind all of that is a difficult macro backdrop. Again, if valuations are falling, with this sector as a whole, how concerned are you about default risk?
Yeah, look, defaults in aggregate are likely to rise, right, across the broader economy. But what we see is that those defaults are really centered around the more cyclical sectors. I think what's important when you think about portfolio construction is to focus on the more defensive sectors. So we think of healthcare and software and technology as areas that are generally insulated against those economic cycles. And those businesses tend to resist better in times of higher economic volatility.
So does that mean with Kreos, you'll only be looking to do non-cyclical deals?
Not exclusively, but I would say the majority of the portfolio historically has always been centered around healthcare and software and technology. And we certainly intend to continue to do so. At the same time, we believe there's a very attractive opportunity set that's developing around transition, sustainability. A lot of these companies are still earlier stage. There's obviously a lot of venture capital money supporting these businesses, and then inevitably there will be some, very attractive business model that will emerge from that theme.
Well, Stephan, Kriti Gupta in New York here. Talk to us a little bit about the size of some of the folks that are involved in the competitive sphere right now, specifically when it comes to M&A. If you look at the smaller credit firms, how successful can they really be in this environment, or do they kind of have to hitch their wagon, for lack of a better term, to a bigger player like BlackRock?
No, that's a good question. I think what we see is that generally LPs are looking to consolidate their relationships with fewer managers, and that will obviously drive a certain level of consolidation. The other theme that we're seeing is that there's more and more complexity in managing these strategies, in particular when it comes to Europe, right? You need origination in the local countries, and it's very difficult to open up an office if you don't already have the infrastructure. And therefore, the bigger managers are better equipped effectively to manage these platforms, and that will inevitably drive ongoing consolidation across the private debt space.
Well, speaking of that ongoing consolidation, are you looking to expand further into private credit via M&A or through other ventures?
Well, BlackRock has very ambitious, growth targets for its private debt business, and we will look at a combination of organic and inorganic, right? Where there is an opportunity to grow organically, of course, we will do that. If the inorganic play is a way to accelerate our entry into the market, then we will consider that as well. But as always, it has to be the right target at the right price with the right culture as well, right? All of these aspects are important. These are people businesses, and therefore it's important to find the right team with the right fit with the BlackRock model.
To that point, Stephan, when you were looking around for deals, and you're still, as you say, currently looking at this area, are there a lot of small private credit firms up for sale right now? Are you spoiled for choice?
Yeah, look, I would say, of course, that there are always smaller private credit firms that are looking to be acquired, and we expect that will be an ongoing trend. We're not going to look to acquire in areas where we already have a presence, right? So when you think about direct lending, credit opportunities or special sits, these are areas where we already have a well-established presence, both in Europe and the US, and we have a team that we're building in Asia as well. I think acquisitions could make sense in areas where, we don't have an existing presence. But again, we don't always look at acquisitions as the only route to enter the market. The organic route
where would that be?
Instances might be the best route.
Stephan, where do you still see the gaps there that you'd want to fill in for?
Look, there's a lot of areas within the credit spectrum that BlackRock are not active in, right? When you think about asset-based lending, secondaries, there's various asset classes. And again, it's not to say that we will acquire a platform in those particular asset classes. But of course, we like to understand, we like to look at what is available and, what market presents the most attractive entry points, both in terms of growth rates, in terms of profitability, in terms of the level of fragmentation, and how we can get to scale.
Look, there's a lot of competition in this area, a lot of dry powder, a lot of money being raised, put to use. And in that, it makes sense. I mean, if you can get a 12% yield on private credit, why wouldn't you go there? 12% is great for investors. But what about corporations right now, Stephan? Can they handle rates and a higher for longer rate environment?
Yeah, look, I think obviously you have to be careful as to how you incorporate debt into your capital structure, right? We believe in the current environment, it's important for companies to give themselves a little bit more of a margin of safety with lower leverage and, to allow for slightly higher interest cover effectively. Because as you said, 10 to 12% is quite high. Now, in the venture debt space, it's slightly different because the yield components are actually a mix of interest and also what we call yield enhancers in the form of warrants and equity kickers, right? So it doesn't all impact the P&L of the company, if you like. A lot of it is actually back-ended and, will materialize as and when the company gets sold.
Stephan, let's broaden out a little bit and zoom out. There's a lot of debate right now in the market of whether there has even been a landing of any sorts, forget a soft or a hard landing at that point. In all of those scenarios, what would perhaps hurt the credit markets the most?
Look, I think generally private markets are generally insulated against the broader economy. Of course, you will have, some differentiation among managers. What we see is in the current environment, if you're focused on investing in defensive sectors, like the ones that I mentioned previously, like healthcare, software, technology, professional services, generally those portfolios will be better insulated, right? Where we see a lot of stress at the moment is in the more cyclical sectors, like the construction sector, the retail sector. These are obviously the sectors that are getting hammered with the current economic environment. And of course, this is not the time to be investing in cyclicals, right? This is the time to be investing in defensive businesses. But clearly, there will be some differentiation among managers. And I think that's a good thing. This asset class still hasn't been tested through a proper cycle. This is a time when managers will be tested and LPs will have the choice between the better managers and those that maybe have a little bit more risk in their portfolios.
But Stephan, it's economics and markets 101 that the private markets lag the public market. So if you are as perhaps bearish as some of the folks on Wall Street are, especially when it comes to cyclicals, at some point there is an expectation that's going to hit the private markets as well. Where do you see that read through?
Yeah, look, generally, private debt portfolios are not as skewed towards the cyclical sectors, right? If I look at our own portfolio, we have no exposure to cyclicals whatsoever. However, the public markets are generally reflective of the broader economy, and therefore you will have more risk. The other aspect that's positive about the private debt markets is that deals generally have covenants. And when you have covenants, you can actually take action before the company faces a payment default. And then the third aspect that's very attractive about private debt is that you're generally a direct lender to the company. And therefore, you have the CFO and the CEO on speed dial. And again, that will allow you to engage well before the company has a problem. That is more difficult with public securities, where typically you're in a broader club. So I would think that generally private markets and private debt in particular should fare better in a more challenging economic environment.
Well, to that point of covenants, Stephan, we saw especially during COVID and before COVID and after, a lot of cov-light covenants getting put through, so less restrictions there. I assume that's what you're talking about when you say that there are some managers who won't do well through a period and that we have yet to be tested in a proper cycle. Stephan, two parts here. Do you think we're going to get that proper test? Is it coming up? And what exactly will that shakeout look like?
I think it is. Look, inevitably, some of those companies that have cov-like structures will be tested through this cycle. It's hard to tell what that will imply, right, in terms of actual default, because we've never seen that yet, right? In the previous GFC, private debt was a really, really tiny market, right? It was only a 5 billion market. Today, it's a 1.5 trillion market globally. And therefore, we have yet to see what the implications are going to be. But we know from experience that companies that have covenants, companies that have lower leverage, and companies that are managed more conservatively generally perform better in a slowing economic environment.
Stephan, I'm afraid we're going to have to wrap it there. Thanks so much for joining us. Let us know when you've done another deal. Come on, join Kriti and me again. We'll have you anytime. BlackRock, Stephan Caron there. Thanks again. Now, coming up, we're going to speak to Klaus Baader, SocGen's global chief economist, as we sort through the implications of Fitch's downgrade. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fitch strips the U.S. of its AAA credit rating, echoing a move by S&P more than a decade ago. The decision draws criticism from the likes of Larry Summers and Mohamed El-Erian. Meanwhile, Treasury Secretary Janet Yellen calls it, quote, arbitrary and outdated. Meanwhile, former President Trump has been charged. The former U.S. president has been indicted in Washington on federal charges over his efforts to overturn the 2020 presidential election. And even in the midst of all that drama, geopolitically and otherwise, earnings season rolls on. AMD rises on AI optimism, while Starbucks slips on disappointing sales. I'm Kriti Gupta in New York with Dani Berger in London. Dani, a lot to digest: earnings cycle, geopolitics, domestic politics, but really that Fitch downgrade seems to be taking the cake.
Yeah, I was going to say all that other stuff you said. I'm not sure we care about it today. Honestly, I'm not sure how much of this is even about the Fitch downgrade anymore by this point, because we're already risk off before it. It did get worse, of course, after the Fitch downgrade, but it seems like we're kind of moving into something else, perhaps moving on positioning, unwinding very popular positionings for the year. We're off the lows for European equities, but we're still down significantly. So far, the worst day in about a month, down 1.33% for the Europe Stock 600, FTSE 100. That's doing worse, down 1.25%. A lot of the higher beta type industries are doing poorly, but every single sector, if you run GRR Go on the Stock 600, you'll see that every sector is in the red today. And just to point to, Kriti, how it's mostly a stock story and everywhere else it's a little bit confused. The Swissy isn't getting a bid. You'd assume that havens would be doing really well today. Sure, gold is slightly up, the yen is slightly up, but the Swissy is weaker today, weaker by 0.25% versus the dollar. There was some bad Swiss economic data, but again, usually this pair moves more in a macro context, so perhaps our worry really is confined to stocks.
I mean, it seems to be, at least on this side of the Atlantic, you are really seeing the pain in the equity spaces. I mean, futures down by 0.8%. I will say they are off their lows, though. But then if you kind of zoom into the tech space specifically, the NASDAQ 100 futures, way more pain, down about 1.2%. It really all comes down to that idea of the Fitch downgrade. But to your point as well, positioning is going to play a big part of it. And I think a good way to gauge that is what you're seeing in the bond market, which is not the same kind of carnage that we saw perhaps in 2011. Simply this idea that the front end of the curve is seeing a bit down, about 4 basis points, 486 on that note. Go further out into the curve, that 10-year yield, which, by the way, in 2011 saw a massive bid on the S&P downgrade, this time virtually unchanged, which really speaks to the idea of how much weight does this move really have on the bond market, Dani.
Let's get more to that move with the downgrade and cover it more. The U.S. sovereign credit now has 2 AA+ out of 3 major credit graders. Only Moody's has the AAA left. From Larry Summers to Mohamed El-Erian, the reaction to the decision has been one of dismissal, that it will have a lasting impact. At the same time, Treasury Secretary Janet Yellen called it arbitrary and outdated. To that criticism, here's what Allianz chief economist Ludovic Sabran had to say in response.
I find that fascinating as a European because, Americans flock together when there is a decision against them. So it's super bipartisan. The same people that have been calling the overheating of Bidenomics, or people that have been, quite respectful of some independence of some agencies are saying, no, you guys are wrong. We're right. I think Europeans should learn a thing or two about this because, to be fair, when we have similar credit events, we tend to self-flagellate a lot more. So I think it's, from this side of the pond, it looks like, you guys are actually very united in this situation of, not great fiscal situation, but at least you're just telling Fitch that you don't care, which I think is quite amusing.
I absolutely love that response from Ludo. The unity of Americans saying that they don't care versus the humble Europeans. Joining us now is Klaus Baader, Global Chief Economist at SocGen. Klaus, I'm sure you know a thing about humbleness among Europeans in the face of sovereign downgrades. Look, but I do wonder how much you look at the criticisms of this Fitch rating and just kind of chalk it up to, as Ludo kind of said, American bluster versus, Fitch actually is right with this decision. It makes sense. Where do you stand on it?
Well, yes, I think it does make a certain amount of sense. If a country again and again threatens to go into default because it can't sort out the politics, then I think it's very difficult to maintain a AAA rating. It's as simple as that. Public sector debt has, of course, gone up very sharply. Longer-term prospects for public sector debt are poor in pretty much all advanced economies and in many, many emerging economies. They're just the credit worthiness is just not that great. And I think it's a kind of a belated move. But frankly, you know, with the history of credit agencies, I have to say, I never look at credit ratings.
I was going to say, I mean, their view, the public view of credit rating agencies isn't that great at this moment. The timing of this certainly won't help. But when it comes to the fiscal standing of the U.S., with a ballooning fiscal deficit, how much impact will that actually have? We can look and say it's not great, but does it spill over into something worse?
Well, we haven't seen it yet, right? I mean, bond yields are still pretty low, both in nominal and in real terms. So no, I don't think we've seen that yet. But it's, you know, one of those things like current account imbalances is this slightly silly saying, you know, they don't matter until they matter. And when they matter, that's pretty much all that matters. At the moment, no, I don't think that that markets really are particularly concerned about sovereign ratings. They are, of course, concerned about defaults going forward in private companies, that's for sure. I mean, our credit strategists are pretty negative.
Well, Klaus, in terms of the tone that it sets, I mean, can we fast forward a year from now? I mean, this was one of my big fun facts of the debt standoff that we last went through, which is in about a year, January 1st, 2025, after a presidential election, which is already going to introduce a lot of volatility into both the economy and the markets, you find the debt standoff there again. Is there any way for the U.S. economy to kind of deal with that ahead of time, or is this an inevitability in just 18 short months?
Well, I'm not sure, because it's completely a political decision, but I find it, you know, peculiar, just like President Biden, I think most previous presidents have argued. It's sort of odd that U.S. Congress has to pass spending and revenue bills. And then it has to make a separate decision about whether that's going to be funded. That doesn't strike me as right. I think once you make the decisions and you approve spending and revenue, then you also have to accept without a separate decision the consequences that's going to have for debt. I mean, as far as I know, there is no other country that goes through that process. Yes, we have, you know, for instance, Germany has a so-called debt brake, which is constitutionally insured. There are other countries, Indonesia, which have limits on public sector debt, public sector deficits, excuse me. But this separation of agreeing on what deficits do and what debt does doesn't strike me as very sensible.
Do you think that when it comes to kind of the conversation in the economic sphere specifically in this next year, perhaps economists, and strategists alike may lean more towards Kevin McCarthy's kind of argument that austerity is the only way forward, perhaps using the roadmap that the likes of Germany, for example, has to offer when it comes to the budget?
Well, you know, Germany, I mean, these things don't tend to work. You shouldn't, I mean, it's very difficult to run fiscal policy, I think, on rules. Because fiscal policy has, in my view, a really, really important and central role in stabilizing economies. And you don't know what kind of shocks are going to come. So I'd be very careful about making strict rules which you know, might really hinder your ability to manage the economy.
Can I go back to this idea of private sector debt? What are you expecting the default cycle to look like?
Well, I mean, economic growth is probably going to slow and continue to be relatively slow. It's going to happen quite late. You see, there's something really interesting that my colleagues were hotly discussing, which is the net interest burden on corporates in the US in particular has actually gone down. Because, and what's probably behind, and this is very atypical, of course, because interest rates have gone up. So what's going on here? And, you know, in a way, a lot of companies have turned themselves into something like banks. When interest rates were very, very low, they issued a lot of debt at longer-term tenors, even though they didn't necessarily need that money. And so they put it in the bank. And now they're still paying super low interest rates on those bonds, and they're getting lots and lots of money from their deposits. But of course, that's not going to last forever, because those bonds are going to mature. I mean, they were, of course, issued at different tenors, longer than usual, 5-7 years. But that's not going to last forever. So while there might be a delayed reaction, you know, the fact is that, one, labor costs are still rising quickly. Unit labor costs are rising quickly. Whether the pricing power that companies have enjoyed is going to last forever is an open question, but I don't think it would be outrageous to assume that it's probably going to fade a little bit. And then in the background, you have higher interest rates. So I think it's going to be very difficult. So the default cycle, you know, don't ask, you should ask my colleagues from the credit strategy about the exact default cycle. But yeah, they think that default rates are going to increase sharply.
Don't sell yourself short. That was an excellent answer. That was fantastic.
Klaus Baader, we have to leave it there. I'm so sorry. So much to digest with you. SocGen's Klaus Baader joining the program this morning about the ramifications that we are seeing of this Fitch downgrade. Coming up, though, we go to the micro. Another chip maker beating the street. AMD shares gaining after topping those second quarter estimates. More on that and a drumbeat to Qualcomm's results next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Meb Faber, Cambria Investment Management co-founder and CIO. That coming up at 2 p.m. New York, 7 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. AMD, Advanced Micro Devices, edging higher in the pre-market. The chip maker topping second quarter estimates. Bloomberg Tech reporter Aggie Cantrell joins us now to walk us through it. Aggie, the shares higher by about 0.8%. AMD seeing quite a bit of a turnaround this quarter. Is it all AI?
Yes, it really is. That is the focus of the turnaround for sure. Essentially, AMD is developing AI accelerated chips, which are crucial in order for companies to tool out their data centers and to speed up AI development. That is a critical part of it, and they are seeing that they are gaining interest in the same way that NVIDIA has done. Not to the same extent, but they definitely are. And this is a part of this broader adage that keeps being heard in this area right now, that there are chips and then there are chips. And a company like AMD is really benefiting right now for having invested in these accelerators that are so crucial for data centers.
We're also going to get Qualcomm reporting results, Aggie, the company that makes semiconductors for phones. What are we looking out for? What's in focus for their earnings?
Yes, so Qualcomm has a huge amount of its focus on the smartphone market. And that is a critical part of this because the smartphone market is essentially, there is a question around the amount of demand, consumer demand, that is still on the smartphone market. It does seem like it is recovering somewhat, especially when you look at certain areas of the economy. There is a risk around China's appetite for smartphones right now. But really, this is a twofold thing. One thing is regaining consumer demand, and the other thing is that when these companies, the companies that buy Qualcomm chips, whether they've done with, had enough, they've reduced their stockpiles enough to start ordering at a greater pace. And that's a critical issue for Qualcomm. And so we're going to be looking out for that too. Have people started ordering again at a pace, and are consumers returning to buy more smartphones?
Well, Aggie, let's just stick with that chipmaker story as well, because we know that some of their competitors, Intel, for example, NVIDIA, are also going to be potential anchors for the ARM IPO coming out of SoftBank as soon as next month. We're getting some news when it comes to the valuation of that. Walk us through those numbers.
Yes, so essentially the crucial thing about this that I found interesting is that they want this as soon as September. Essentially, SoftBank is looking to cash in on this bullish attitude towards chip developers, especially these chip makers that are making these high-end AI chips. That is really where this is. They're pushing for this early IPO, potentially as early as next month, because they really want to be able to capitalize on that. And when you look at ARM, you're also seeing a shift in that valuation from the public markets. We've seen the NVIDIA boom a month or so ago, and now we're seeing that this valuation is potentially between $60 and $70 billion. Earlier this year, bankers were rating this at around $30 billion at its lowest level. And so we're seeing that this IPO could be a real boon for SoftBank at a time when they really need it.
Yeah, $60 billion, massive. Aggie Cantrell walking us through all the stories we need to know in the semiconductor space. We thank you, as always. We go from big tech to big coffee, I suppose. Starbucks quarterly sales fell short of analyst estimates. Joining us now, Bloomberg's Simone Foxman, all over it. Simone, the results flagged weakness among North American consumers. Is this just the people like me who are saying $7 for a caramel latte, you just can't do it?
Well, a lot of Starbucks' success recently has been built on the back of price increases. And so what these numbers are suggesting, the important 7% increase in comparable sales on a year-on-year basis, coming in lighter than expected. The anticipation in the United States was for 7.7%. But yeah, essentially, there are customers still looking to customize their orders, but they're also, these customers have faced a lot of price hikes, especially continuing to face lots of price hikes at restaurants. And Valerie Titel put together a really interesting chart for us, just showing that the cost of eating out, food outside the home, and this coming from CPI data, is really continuing to rise, whereas we've seen costs of groceries stabilize. So yes, when you order a $7 drink, there is just a limit to how much these prices increases that a North American consumer can apparently tolerate, and that's what Starbucks is seeing.
I mean, it's kind of the adage, right, when you're talking about personal finances, stop going to Starbucks, make coffee at home. So you'd assume Starbucks is the first they ditch. Overall results, away from just even the U.S. consumer, what else stood out?
Yeah, and I mean, admittedly not necessarily ditching the venti latte, but certainly not wanting to buy more of them. I think other things that stood out, really China is very important when we look at the Starbucks story. We saw the comp sales numbers there rising 46% on a year-on-year basis. That's, you know, a little bit hotter maybe than some analyst estimates, roughly in line with most of them. But I think the concern there, really the outlook. You know, Starbucks executives on the call yesterday pointing out that there isn't as much penetration in the Chinese market as there is in somewhere like the United States. But there is concern that, you know, if you only see comp sales return to normal at like a high single, maybe mid single digit pace, that's going to be a little bit of a problem. Also, one thing that we're really watching is how much money the company is spending on wages. They've had some tangles with their union, so that's an important one as well.
Certainly something we're going to be keeping our eye on. Those shares already down by about 2% this morning. Simone Foxman walking us through all of those earnings stories. Coming up, more on the fallout, Fitch's U.S. downgrade. Stick with us. This is Bloomberg.
This is clearly negative press, quote unquote, for the U.S. at a fairly fragile time internationally, as you point out. On the other hand, you know, there's no replacement, obvious replacement for the U.S. as the dollar currency.
Berenberg Capital Markets senior economist Mickey Levy there, weighing in on the Fitch's U.S. downgrade. Joining us now for a little bit more context, Bloomberg International Economics and Policy Correspondent Michael McKee. Even I'm old enough to remember the last downgrade for the U.S. credit rating. And look, this is pretty normal that a lot of the members of Congress and some of the economic officials are saying, look, this is unjustified. Is it unjustified?
Yeah, you could argue it is, because the U.S. has its own printing press. It's a sovereign country. It can deal with its debts. They've never failed to pay, despite the drama that we've seen. Still, Fitch does have a point when they talk about the future trajectory for the U.S. The repeated debt limit political standoffs and last-minute resolutions, they say, have eroded confidence in fiscal management. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. Now, that's a justifiable reason for being concerned about the path of deficits. The question is, does it matter to anybody? Not really. The cognoscenti are weighing in, and Fitch is getting very negative reviews. Same sort of thing that happened back in 2011 to S&P. Janet Yellen, of course, calling it arbitrary and based on outdated data. Former Treasury Secretary Larry Summers calling Fitch bizarre and inept. And Jason Furman, the former chairman of the Council of Economic Advisors, saying it's very hard to understand.
Well, I mean, we're looking there at some of the criticisms, Mike, and I think a lot of it seems to be around the timing of this. When S&P did it in 2011, it was just days after the sovereign debt crisis, over the debt ceiling after that had been resolved. We're months afterwards here.
Yeah, it doesn't make a lot of sense. I tend to agree with Jason Furman that maybe this might have put a little pressure on Republicans and Democrats during the debt ceiling fight, but now that it's over, that's suspended for 2 years. We won't revisit that till 2025. So kind of what's the point? When you look at what happened after 2011, and as you point out, that came out just a day or two after the debt ceiling was solved, well, we had a brief reaction in all markets, and then you can see stocks went up, the dollar went up, and bond yields went down. So this kind of fits that old Shakespearean line about sound and fury signifying nothing.
But it feels like there may even be, just to play devil's advocate here, a point to what Fitch is saying in that if you are looking to this next debt ceiling standoff in, I think, January 1st, 2025, which comes right off the heels of a presidential election and coincides with the lame duck session in Congress, how are you supposed to fix the next debt problem if you're not even entertaining the idea of the austerity measures that Kevin McCarthy had put forward?
Well, here's the problem with Fitch, and that is that this is going to be forgotten by then. Nobody on Capitol Hill remembers S&P downgrading them, and clearly when you look at what happened to the markets after that, there was no impact. So if the idea of defaulting on U.S. debt doesn't move people to do something, Fitch piling on isn't going to move people to do anything either. And it's going to be very interesting. A lot of this is going to revolve around the Trump tax cuts, which expire for individuals in 2025. Then you could see some additional pressure from the ratings agencies if they're renewed and nothing is done to offset them. But that's a problem for another day. And as we all know, Washington loves nothing more than to kick the can down the road.
A lot of deadlines in the Washington Planner. Bloomberg's Michael McKee walking us through all of it. But it's that exact point that Mike was just making when it comes to the bond market, because take a look, it's not doing much. And the S&P 500, the S&P downgrade story back in 2011, you saw this massive bid into the front end of the curve, Dani. You are not seeing that this time. The 10-year yield at 402, literally unchanged when it comes to that. Meanwhile, the equity market taking the brunt of the hit.
Yeah, a lot is different this time than in 2011. We also can't forget that in 2011, there was also the European sovereign debt crisis that pushed us into U.S. sovereign debt. And at the same time, the worry for the bond market, the reason it got punished yesterday seems to be the Treasury saying that it would have to borrow about $1 trillion for that widening deficit. That supply seems to be a bigger story. All right, that's it for Kriti and me for early edition. Surveillance is up ahead.